Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com chats about crude's drop in popularity and what's behind it. Robert Campbell, publisher of the realestatetiming.com newsletter, comments on the state of real estate. He says markets around the planet are a lot different than they were just a short time ago. Glen Kelleway from Kelleway Mortgage Architects talks about how you can get the best deal when it comes to getting a mortgage. He says the banks are not the only source of money. Plus, at the end of the show, we'll have company showcase updates from American Manganese President Larry Reaugh and Cypress Development CEO Bill Willoughby. We'll talk to Ross Clark right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp, RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com. Welcome back to the show, Ross.
Nice to be back, Jim.
Ross, did we have historic days in the past little while here for crude oil, or did it just look historic?
Well, it's historic by at least one measure. That would be the number of consecutive down days. When we got to 10, it was starting to match the 1984 levels, and by the time it got out to 12 in the middle of the week, that puts it into record numbers. Now, it's percentage-wise, if we take a look at the size of the drops, they're not as big as they were, say, back in 2008 when we had dropped from $147, and also back in 2014 we had dropped from $100 at that point. Those movements were larger in magnitude. However, they came to a conclusion much faster. So this one has actually slowly built momentum, if you look at the daily charts, to the point where Monday, Tuesday, we started to see capitulation signals in our work. The DeMark counts that we look at, the sequentials, which had given a sell signal right at the high close there in September when we were up at 76, they are now giving us the opposite signals. They are giving us buy signals. We would need to see some stabilization in prices here and a reversal to the upside, though, to say that this downtrend is over. Because I think for all that just about any oscillator one could put on the oil price would show that they're oversold on a daily basis. You know, the weeklies, we've given back maybe 40% of the run-up from the lows in 2017 and less than that from the one in 2016. So our major outlook here was that we could break 35%. That's the norm for a break in the fourth quarter of the eighth year of a decade. You break 35% from an interim high before you put in a major low. So the optimum target here is going to be closer to $50 than the 56.5 that we're at right now. And the way that we've been coming off, the oil and gas stocks in Canada are going to be down to some pretty good levels in terms of buying. As far as tax law selling is concerned, the pressure that should come in and the opportunities that we see between here and the middle of December should be exceptional.
Bombardier stock was down 20% after they announced 5,000 layoffs. Is this something Canadian taxpayers should be worried about because we have such a big stake in the company?
Oh yeah, I mean we've stepped up to the plate how many times as far as Bombardier is concerned. it would be surprising to see them, the federal government let them go under. They are going to do whatever they can to maintain as many jobs as possible. But, here's a stock that's gone from $5.50 at the middle of the summer, trading now under $2. Here's one of these things where you look to say, is a company going to go belly up? If not, then you step up to the plate and buy it when there's blood in the streets. And that's the way that these charts are looking right now. So if you think that Bombardier can continue to exist under some plan, then this becomes a very attractive level to look at. Maybe do some scale in purchasing down here, because the whole sector is not doing all that badly. I mean, if you look at the other names, you look at Boeing. It has managed to hold in reasonably well. Personally, I think it's more of a distribution pattern up here, but it's within, at this point, 10 or 15% of its all-time highs.
Gold seems to be inching back up again. Is this a case of it's as low as it's going to go, or could there be more bargains to be had?
Well, so we have to look at it in terms of the bigger picture here. We gave back 60% of the run-up off the low into the middle of last week. And we've now had bounce back to 12.22 as of Friday's close. The big resistance is at 12.46. And the way I look at it, as long as the gold market can't get back through the 12.30 to 12.35 range, I think the pressure is still on to the downside. In terms of the complex as a whole, if we look at silver, we see that 2 days ago we had an outside reversal day. That was a day with a lower low followed by a close above the previous day's high. So that kind of a reversal, you see maybe twice a year in the silver market. And on average, you'll see a 1 to 2 week recovery rally out of that. Not necessarily the beginning of a bull market move, but a good reaction to the upside. So I think maybe we need to look at gold and silver and see how they do on this bounce right now. And if it loses momentum in the coming week or so, then I think you're still set up for a move to the downside. Interestingly, if we look over at the base metal side of the equation, copper, which had been up at the 330 level back in the spring, and we've actually been using that as one of the models for the break in the oil market, it has put in a very nice bottom. We see the consolidation now is on the monthly charts as presenting a very good oversold condition, and stability is kicking in. And so if there's any change in upside to produce some upside momentum here and breaking out through 280, I think you could see a pretty good run in the copper price.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Coming up, Robert Campbell next on This Week in Money.
Always consult your investment professional before making any investment decision.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Robert Campbell, publisher of the realestatetiming.com newsletter. He's speaking to us from the great city of San Diego. Welcome back to the show, Bob.
Hi there. How are you, Jim?
We're doing great. Bob, with interest rates continuing to rise, are you getting any sell signals for real estate in the U.S.?
Yes, I am, and it's the surprising you asked, my friend Jim, because for the first time in since 2011, I got my real estate timing model produced a major sell city, produced a sell signal for the first major city in California, and that city is San Francisco City. That's quite a change. I mean, and that is what's really interesting about that system up there. Housing prices from 2012 to 2018 tripled in value. The median price home went from $600,000, Jim, to 1.8 million in 6 years. 6 years. That's a triple. Does that sound like a bubble to you?
Well, it would be the classic definition, I would believe.
It's beyond that. I mean, that's even going. Prices never appreciated like that in Vancouver in 6 years. Did prices ever triple in Vancouver in 6 years?
Depending where you live, yes.
Okay, then it is. That's a similar bubble. I know Vancouver's was a big bubble. That's why I make the comparison. You know that market better than I. I mean, I've seen charts of Vancouver. It's crazy. I mean, and so is this chart of San Francisco. So anyway, it's a sell signal. And what's interesting, that's the city, all the areas surrounding the city. East Bay to the east, Oakland, to the south, San Jose, Santa Clara County, Silicon Valley there. Then up north, Napa, Marin, all those areas, those are they're going to go sell as well in the next, 2 to 4 months. And then after that, and because what happens in one major California area happens in all of them, all California is going to get a sell signal. And in other words, I think that to a large degree, we're at or near the peak in a lot of markets right now here in California and probably in the United States.
Is it interest rates that are breaking the camel's back in San Francisco, or is it the old adage, the cure for high prices is high prices?
The cure for high prices is high prices. I mean, interest rates, that a rise in interest rates from 3.5 to 5, or from, down from 3.5 to 5, prices were still going up in the Bay Area during that time, a tripling of prices. So interest rates is the least predictive, usually the least predictive indicator that's in my timing model, even though that I use it. So what the biggest thing is, prices just rise to a level where subconsciously or consciously buyers go, no mas, then the cycle starts reversing. Then that's the peak. It's the buyers back away. The sellers don't get smart and go, boy, I'm going to unload this at 1.8. And, that's the way it is at the top. And that's probably what's happening in San Francisco. Oh, they're super overvalued. I've been writing about that in my last 2 timing letters. And I think Bay Area housing prices on a real basis, adjusted for inflation, not nominally, which is, the best way to show the wide range in the cycles. I think Bay Area housing prices are probably going to go down on a real basis anywhere between 35 and 40%, maybe more.
Was there always a feeling that markets like San Francisco and Vancouver, where you really have a limited amount of land because you're bordering on the ocean, that real estate prices can only go up because so many people move to those cities every year?
Yeah, they can only go up so high, though. I mean, everything has some kind of upward limit where people can't afford to pay the price anymore. I mean, there's a lot of things that, there's Picasso paintings. There's only one in the world of them. And they're selling for $150 million. That doesn't mean you can't, hang on to them and until somebody's willing to give you, $300 million for them, that within a short period of time. I mean, there's a limit to everything. It only goes up so high. Everything only goes up. The old saying, I know it's cliche, trees don't grow to the sky, but it's true. And all you need to do is, if you don't believe me, just go back. Anybody doesn't believe me, not so much, not you, Jim, but go back and read economic history. Look at the cycles. It's amazing. I mean, you don't have to believe. Just trust what your eyes are showing you. That's what's so amazing. And you go back, the older you get, the wiser you get, because you've experienced more, and all of a sudden you start looking back more and you go, of course it's cyclical. Everything in life is cyclical, and he who calls the turns most accurately as an investor is the most successful. Like Ray Dalio said the other day. I'm starting to appreciate Ray Dalio, who runs what is it? He's that big hedge fund giant. What's the name of it? Bridgewater or something like that. But he said you can make money in the markets only when there's an opportunity to make money in the markets. In other words, markets go both directions, and most people don't give enough acknowledgement to the fact that there are significant downturns in markets too. I mean, and that wipe a lot of people out, especially when you're over leveraged. And people tend to get over-leveraged during good times.
Well, they believe the slogan or the saying, this time it's different. Is that the worst thing you could ever listen to or pay attention to?
They have, you know what? Because like Buffett said, they're too greedy when they should be fearful. That's human nature. That's never going to change, Jim. That's what's so amazing about it. The markets change, but human nature never does.
People also like to go along with other folks. I remember my birthday last year and a friend saying, hey, do you have your Bitcoin yet? Mine's up to $20,000. And the very next day it crashed. And today I think it's down 10%. So when everybody tells you at a party, this is the hottest thing to buy, I think that's the time to dump it or ignore it. Would that be the right advice?
That's generally good advice. I'm a believer that you need a system, a more of an objective system to make those calls. But that's what you have to do. The goal is to sell high. Okay, and not buy high. The goal is to sell high. Good. Now you need a strategy for doing that. So you need a goal and a strategy. But absolutely, the average American, the average individual investor does way more poorly than the averages, like for stocks or real estate. You know, it's really true, even though it's hard to quantify it's not hard to quantify with numbers. Go look at the cycles, and you look at, like for example, existing home sales is my number one leading indicator out of 5 that I use for predicting major turning points in the market. Like at the bottom of a cycle, there may be, like, let's say 5,000 buyers and sellers, you know, that are making a transaction. 5,000 at the bottom when prices are low. You know what the number is at the top? 10,000. Right? So that means there's a lot more people there that are buying high than are buying low. And every one of those guys that bought high is going to get screwed when the next downturn hits, because most of the majority, especially in real estate, are over leveraged. It's all leverage, Jim.
Are there American cities that are getting close to sell signals, or are we already there?
Well, California is right at or near the peak. Other places in the country are not going to be far behind, even though that they're not there yet. For example, I think my last issue, I think Chicago's very close to a sell signal. Chicago, people are leaving that state. 1 million people left Chicago last year. It's the only state, only one of 50 states in the country that had a loss of population in last year. They're leaving because taxes are so high. They're having to overinflate. They're having to tax real estate. Property taxes, have gone up, 25%. I think at least twice. So it's expensive to own real estate there. And people are leaving. They can't afford the taxes. And it's because their pension system is so broke. They're almost like 80% underfunded. In order to pay the pensions for the government workers, they've got to start cranking up taxes to pay the free lunch, to pay those inflated pensions, and the city's going downhill. It's similar to what happened in Detroit, Jim.
People from mainland China bought a lot of real estate in Canada, especially Vancouver. Have they also snapped up West Coast real estate in the U.S.? And could the downturn in China's economy see those people try to desperately sell their properties in North America?
I don't know how the Chinese act. are going to act, because I haven't had any experience with this. Let me tell you how some other Asians reacted in the past. Japan did the same thing during the 80s. From 1980 to 1990, they were their economy was growing faster than anybody in the world, and everybody thought Japan was going to be the biggest economy, replace the U.S. And during that boom, the Nikkei Dow went to 40,000. Real estate was soaring. They took those profits, out of Japan and bought California real estate, prime California real estate at the peak, in not only California but Hawaii, resorts and things like that, and completely lost their ass. All those places ended up selling at they lost 50, 75% on their money. So I don't know. I'm just telling you how, you don't get rich playing another man's game. And as far as I'm concerned, Chinese coming to the U.S. to get rich in real estate, that's not their game. That's our game. So I probably will think that it won't turn out quite like they had hoped for or anticipated.
We'll have more with Robert Campbell when This Week in Money returns.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Bob, historically, where have American real estate downturns started?
I remember back when I was a kid. I'm 71 years old, Jim. Back when I was a kid, I've been around real estate my whole life. I remember there was a time, I think it was in the 70s or 80s, we had rolling recessions, rolling real estate cycles in the country, in the United States. And I remember it started on the East Coast, and it took 2 years to get to the West Coast. That doesn't happen anymore. It tends to be more simultaneous. That because of the Federal Reserve policies, central bank policies all around the world, most real estate, markets in the country are still, very expensively priced. I mean, it looks like a lot of them are peaking out, but they're still expensively priced. And it started on the east and then went to the west. And I mean, now it's kind of a global thing more than anything. But California, in my mind, it's always tended to be like ground zero for a lot of things financial. It's not Wall Street for sure, but when it comes to real estate, I mean, our real estate market is the most expensive in the country. So, whatever happens here there's gonna be an after, it's gonna emanate outward from here. So when we start, hitting these peak prices and go into our downturn, I don't see how the rest of the United States can stand up to it.
Are U.S. financial institutions constricting mortgage credit?
Not that I'm aware of. In fact, if anything, they may not be making them easier to get, because I don't know. That's not my business. But I'll tell you, a lot more programs have been floated in the last 6 months where it requires, where it's lower lending standards and no money down and that kind of thing. I mean, it's not to a large degree like it was the last real estate bubble we had in the States, but it's still, it's there and it happened. Interestingly, the last real estate bubble in the United States was a result of easy to get mortgage loans. If you fog a mirror, you qualify. This housing market bubble or boom is driven by record low interest rates. And that's why interest rates are so important right now. When rates got down to 3.5%, a house was priced accordingly. Everybody would bid prices up to where, they could spend, 45% of their income on a house. They had so and such a mortgage, and houses got priced accordingly. Now the interest rates, from right now till a year ago from today, interest rates are a percentage higher. And that means, on average, the average American, for the same mortgage, it's going to cost you 13% more today than it did a year ago. And that's why the market's in trouble. It's affordability. It always comes down to affordability. I mean, that's what it comes down to. You just can't afford it anymore. And that's another reason the sellers back off. They go, look, we need this big a house, or we want this big a house. And all of a sudden you get a smaller house for the same price, and they don't back off, and they're not willing to pay the higher price. So they stop, and then that's what stops the upward momentum. Then the sellers get the picture, and they start cutting prices. Then the sellers start cutting prices. The buyers notice and go, well, seems like it's, prices are starting to fall a little bit now. Now there's no incentive to buy now because, maybe next year the prices will be cheaper, And that's the principle that rules all down cycles.
Is England in a real estate bubble?
You know, the housing bubble in England is huge. It's much more pronounced than the U.S. or Canada. Maybe Canada. I saw a chart of Canadian housing prices versus U.S. housing prices. A chart of real prices going back to 1975. Real housing prices, U.S. versus Canada. From 1975 through 2006, we both kind of tracked, you know, you can see the cyclicality. You know, sometimes your housing prices were higher, sometimes ours were higher, but basically it was a pretty close correlation. Come 2006, that was the peak of our housing bubble. We took a big dump and went down, housing prices. You start accelerating to the upside. I find that's amazing that happened. I mean, it's really pronounced now. You've never seen this kind of divergence between Canada and U.S. housing prices. It's huge right now. Way bigger than anything we've seen in the last 40 years. It's like, you know, 5 to 7 to 8 times bigger, that divergence. That's how big that gap is right now. And I don't know how to explain it, but I mean, that's the way it is, and I just find it fascinating. Mike, you know what my conclusion is? Housing prices in Canada are going to, would I say, is California prices going to go way up to catch up with Canada, or is Canada's housing prices going to come way down to get into line with the U.S.? I would bet on the latter.
Is there a historical correlation between the price of homes and interest rates?
It's very loose. It's very broad. You know, it's not worth looking at. It's nothing you can make investment decisions on. You know, you really have to torture the mathematics to come out with something. Because like I say, you know, that's my least predictive of all my 5 leading indicators, interest rates. If it was a good leading indicator, I would weigh it much more heavily in my real estate timing model, and I don't. It's ranked the lowest.
Is Canada in a bigger real estate bubble than the U.S. due to the currency devaluation of the Canadian dollar?
You know, I haven't seen that devaluation. I mean, the devaluation is that I think the Canadian housing market is at greater risk of a more significant downturn than the United States. I believe that. For whatever reason. Currency, homes are just too high priced. It's too hard to follow a lot of these things, these currencies. I'll tell you, the dollar is going to keep getting stronger, and it's hurting a lot of people, Jim. I didn't know it hurting Canada that much, but a lot of these, you know, emerging markets that are holding all this, oh my God, it's killing these guys. And you know what? I think it's going to keep killing them. I think interest rates are going to keep going up. I don't think the Fed's going to back off, even though you hear this stuff. Oh, if the U.S. stock market falls 20%, you know, and Trump's, you know, twittering away about, you know, that the Fed's really, you know, screwing things up. I don't think they're going to stop. I don't think they can stop. They got to get things back to some kind of normal. They got to put an end to this speculation that's in the market, and they just can't let it go on forever. Like you guys have done with Canadian real estate. I mean, with Vancouver real estate, right? Or Toronto. Has Toronto started correcting yet?
Yes, it has.
Good. And Vancouver. I don't follow it as close. I don't hear much. I mean, in Australia, it's starting to correct. But I mean, you look at the correction. It hasn't been a significant correction yet. Correct? I mean, what's it been, 5 or 10%?
Yes, and what people are just knowing is they're listing their houses at prices they expected to get 2 years ago, and nobody's buying.
Well, of course. There's human nature for you again. I mean, has that ever worked in time? No. Does that keep idiots from retrying that same strategy? No. I know that I am totally convinced that, you know, to be as successful as you can be in markets, you have to be. What it comes down to is how aligned are you with the real world?
We'll have more with Robert Campbell when we return with more This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Robert Campbell. Bob, would interest rates doubling now versus the 1980s have a similar impact on the price of homes?
Yes, very similar. Well, back in the 80s when it was happening, inflation was running about, let's say the 70s. Inflation in 1980, 1981, inflation in the U.S. peaked at over 13%. But inflation was much higher then than it is now. And then, Bill Clinton, the president, changed the formula for calculating inflation. And now, of course, it's much lower because they don't count anything, but it was. And I remember then, when inflation was 10%, 30-year fixed interest rates were 14%, 13%. Then it got up to 7%. Then inflation got to 13%. Believe it or not, T-bills got to 22%. 90-day T-bills got to 22%, Jim. Do you think if the government had to stop inflation, let's say inflation started coming on hard, and to save our currency, the U.S. dollar, we had to raise interest rates to defend it. Do you think our debt, the U.S. would survive with 20% T-bill rates right now? I mean, that's a rhetorical question. Of course it can, because the debt service would be incredible. So in a lot of ways, I mean, you just keep piling up this debt, and it's true. At some point, it's going to become a problem, and people are over-leveraged, and that's going to be, you could have another big price correction again, another crisis on our hands. The cycles are getting more extreme. They're not shallowing.
If house prices collapse 40%, 50%, could it take as long as 17 years to get back to the prices we have now?
Oh, absolutely. You don't know how long it's going to take. In Japan, housing prices fell, from a peak in 1990 to a bottom in like 2006. What are we talking, 16 years? They fell 60%, 50%, 60%. And today they're about 10% off the bottom. Oh yeah, they can stay down a long time. You even have isolated places here in California. I mean, I mentioned California because I've lived here my whole life, and I've been in the real estate business my whole life. So these are the markets, these are the cycles I'm most familiar with. But here in Southern California, for example, that if you'd have bought a home in Palm Springs in 2000 for $100,000 in 2000, today, 18 years later, because of the cycles, I mean, it went up from 100,000 to 200, then back to 100 and stayed there. 18 years later, they're still worth $100,000. So in other words, it's taken you 18 years to get back to break even. And there's other markets that's a pretty extreme, but Bakersfield, for example, I mean, you've had markets before that once they fall, they can really, really take a long time to get back to break even. Las Vegas, one of the hottest housing markets in the United States is Las Vegas. North Las Vegas in particular. It's risen something like 135% off the bottom in 2012, from which housing prices collapsed. It's still not even back to break even, Jim. After 135% rate of appreciation, you're still not back to break even. And this is, this is 12 years later. That's crazy. That's crazy price appreciation and depreciation. And the point of that is you don't know what's going to happen in the future. And that's why most people are well advised to avoid bad housing markets and only be invested in real estate when prices are likely to appreciate, and be in some alternative investment that looks promising when real estate prices are expected to go down. because the cycles can be extreme, especially where I am in California. This is boom bust real estate city, real estate state number one in the United States. I mean, you can get super rich during the good times, and you can go broke fast during the down times because the cycles are really extreme. So it's one of those things, like the stock market. It's that I don't trust any market. That's why I always go back to Ray Dalio. What he says that you can only make money in the markets when the opportunity is there. In other words, the opportunity to make money in the markets, prices have to be rising. If the opportunity is there, go do something else with your money. I like that. I think that's a great approach.
Do real estate and asset prices normally rise at the rate of inflation?
Housing prices in the United States going back to 1890, Robert Shiller, the Nobel Prize winner that has a Nobel Prize in behavioral economics, he's taken U.S. housing prices back to 1890 through today. That's 128 years. And through that 128-year period of time, on an average, U.S. home prices have appreciated a little less than 1% when adjusted for inflation.
Has purchasing power decreased over the past few decades?
Oh, absolutely. It decreases every year. And the government says it decreases by the amount of inflation. So if the government reports inflation at 2%, your purchasing power drops 2% every year. And that's one of the biggest reasons you want to avoid bad markets. Because, let's say, for example, in Las Vegas, or let's just say a house is $100,000 in California at the peak, and it drops to 50, and then it takes 12 years to get back to break even, get back to 100, to get your money back. You've got $100, you got your $100,000 back, you think you're at break even. Just for those 12 years, just say inflation's 2%. You know it's more, but let's say it's 2. You've lost 24% of your money in purchasing power. And purchasing power is what counts. That's what's so devastating about down markets. That, not only do you lose your principal, you're losing the purchasing power of the principal that's still there.
Are seniors working past 65 because they want to or because they have to?
They have to. They have to. It's so amazing. It's so amazing. You go back to the year, I think it's 2000, and you say, okay, and they divide workers up by age, over 55, over 65 as age groups, and see how many people have been added to the workforce in that period of time. Those are the only two age groups that have a net positive over that last 18-year period. All the other ones are lower. In other words, so what I'm saying is people have to work, Jim. People have to work. And the older people, and that wasn't the plan. And that helps explain in a big way why Donald Trump got elected president of the United States. Things aren't as hunky-dory as everybody wants them to make them out to be here in the U.S. Because when we're talking about that over 55, over 65 group, we're talking about 80 million Americans. Those are baby boomers. That's the biggest segment of the society right now. Maybe the new millennials, but a bigger and bigger portion of them are still working. I don't think that was the plan, Jim.
Are more and more people reaching retirement age still owing a lot of money on their mortgage?
Yep, they are. Big change. I mean, let's go back when, back to the 50s and 60s. My parents around there, when they were starting to have kids, when I was born. You used to hear about people, they'd get a mortgage and they'd have a mortgage burning party and all of a sudden, and that's when they were older and retired, so at least they'd own their home free and clear. That's not the case anymore. Not only are the older people over 55 years old, still a greater percentage of them, still working more and more, an increasing number, I should say, they're also going into debt more and more. Like you maybe go back, let's say, 30 years, and maybe all people over 65 that, the average mortgage of a person over 65 would be like $40,000. Today it's $90,000. People are deeper in debt today, even older people. So as long as whether it's debt or whether it's paying property taxes, can you afford to live on no income today? Nothing. Property taxes are a big problem.
If California continues to raise taxes, at some point, will productive people move to another state to avoid them?
Oh, absolutely. I mean, you know that it's going to happen. What California's got going for it is the climate, especially here down in Southern California. It's the best climate in the world. In the United States, maybe in the world, it's the same climate as in along the Mediterranean Sea, in Greece and Italy and Spain. It's that wonderful climate. If all of a sudden that we have the highest state income taxes already, like 13.5%, if they have to start raising these things up like to 20%, and along with federal income taxes, I mean, pretty soon, and being self-employed with self-employment tax, pretty soon the tax rate's going to get up to 65, 70%. People will leave, or they'll stop working. Wealthy people will stop working, or they'll move somewhere else where it's not as bad. But I mean, if all of a sudden, what's the point? If all of a sudden you got a good business and all of a sudden they're taking 70% in taxes, you might just go, screw it. It's not worth it anymore. This isn't right.
Bob, thanks for being on This Week in Money.
Oh, my pleasure, Jim. Anytime. Let's do it again soon, okay?
You got it. My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. He was speaking to us from San Diego. Coming up, Glen Kelleway, next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp, RMO on the TSX Venture Exchange. Rainy Mountain Royalty Corp is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Vatic Ventures Corp is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm speaking with Glen Kelleway. He's the broker-owner of Kelleway Mortgage Architects, located in Maple Ridge, BC, serving clients across Canada and international clients who want to seek financing in Canada. Welcome to the show, Glen.
Thank you, Jim. I'm glad to be here with you. Thanks for inviting me.
Glen, why should people use a mortgage broker instead of dealing directly with a financial institution, usually their own bank?
That's an excellent question. Well, financial institutions have one product. They know you as the client, so they might be able to cut you some slack. But we're finding now today that a lot of clients are not able to get their banks to give them the financing that they want. And it might be that the green bank, your TD or other, or red bank, CIBC, just does not have the policies in place to allow you to finance. But I might be able to take you across the street to a different bank, same sort of pricing, same sort of deal, and just get the deal done. Or maybe find that deal through a credit union where the big federally chartered, federally regulated banks can't loan you the same funds for the same pricing, or very similar pricing. So the reason why mortgage brokers have a place in there is we source funds from many different suppliers. We have access to trust companies, private, so if it doesn't fit with the bank, it could end up going to a private lender or a mortgage investment corporation lender. Other reasons why to use a mortgage broker, typically you don't need to book a branch appointment or wait till someone shows up in your house. We do a very fast gathering of information, gathering of documents, and then can get back to you with some options. We're licensed. The other thing is the bank staff are not licensed in jurisdictions in Canada. In the United States, a lot of the bank staff have to be licensed, but here in Canada, all the bank staff usually have is a 2 or 3 day course. We, in the province of British Columbia, have to complete a university-level course. The fastest you can get that done is 3 months. Most people take 6 to 12 months to get that course done. And then you have to sit an exam, and only, it's a 60% pass rate, and there's probably about a 50% fail rate on that exam, because the math is very, very tough. The other reason is the banks are not required to disclose. Another reason to talk to a mortgage broker is a mortgage broker is licensed, and they're required by law to look after your interests. They can't lie to the lender, but they've got to look after your interests. That means they're going to tell you about an interest rate differential which the banks won't tell you. They'll say 3 months interest or interest rate differential. They won't explain that the 3 months interest on the variable rate product could be a couple of grand, but the IRD, the interest rate differential, could be 12 or 15 grand. It could be 4% or 5% of the outstanding balance. So these are things that when you work for your employer, you're not responsible to the buyer or the customer coming in. You're responsible to your employer. The other thing that I've heard from many banks, because I recruit bank employees to come and work as my agents, they still have to pass the course, is they have to push various other products like insurance. They're required and mandated to push insurance. They have productivity levels they have to fulfill. We've all heard about the stuff in the market now with banks, employees, and the CBC interviews with bank employees saying they're required to push a lot of products down there. One thing that will happen if you go into branch, as opposed to dealing with a mortgage broker, is you're going to deal with a generalist. And that generalist does RSPs, they take credit card applications, so they might not be that expert in lending, especially if it's in a smaller market community. So those are kind of the four things: independent, price, choice, options, licensed, and the specialist aspect, where that's what I do, is I find financing for people.
Are we finding banks not as eager to lend money for mortgages right now?
In general, the banks are controlled, and some credit unions, such as Coast Capital, is now regulated federally. So they're coming under the federal regulations, and that requires them to restrict what they can lend out on. So they cannot lend out on, let's just say they have certain rules and regulations, certain loan-to-value limits, certain credit score limits that will restrict what they can loan out and how that loan looks on the books. So yes, they are loaning fewer dollars out, which means those dollars people are still looking for funds. So 1 in 5 wealthy people will be not able to get financed, even though they've got lots of money, lots of income, lots of down payment. There are reasons why the banks can't stretch to get them that loan they're looking for the $4 or $5 million house. And that goes the same for the person buying the $1 million house.
Glenn, is something that people might have to watch out for as well is they're thinking about allowing banks, if you have a home equity line of credit, a HELOC, instead of when you go to renew your mortgage for, say, $300,000 and you have a $100,000 HELOC, they're going to take that HELOC as if you've maxed it out and include that in the debt that you're looking at. Is that a fear among your clients?
What you're talking about is reassessing the financing at some point in the mortgage contract. If someone has a HELOC, a home equity line of credit, they've signed a document. Typically, there's what's called a collateral charge on the property. That means it's an all-encompassing charge. Some of the credit unions, you buy a $500,000 piece of property, and they'll register an $800,000 or higher collateral charge. They register something above the value of the property so that they tell you they can loan you more money if you qualify. It does cover up the rest of the property, so that if you're only borrowing $200,000 on a $500,000 property, but the credit union or some other banks use collateral charge, TD, National Bank, Scotia does some, RBC, they register a higher charge on the property. That clouds the title, so you can't get at the excess equity. When you have a HELOC, there is no endpoint. But, Jim, as you're saying, some of the banks are looking at credit history at mortgage renewal, and then they're pricing up there. So if you've impaired your credit or you've got more debt there, they can offer you not the best rate that they would offer, say, you or me, Jim, walking in as new clients to the Blue Bank. They're going to offer the existing client a higher renewal rate than they will to new clients. You have to go back in and negotiate. And if you're in a position where you can't move because they've done the numbers, they're not going to negotiate. I've seen this now with 2 or 3 clients. We've switched them to another lender. That's a whole other conversation about if you got funded before October 2016, I can apply the old rules at that point and move some of these clients with collateral charge mortgages across and get them better deals at lower payments. Just, it's a huge benefit. So another conversation before, if you're funded before October 2016, there's some deals to be had out there.
Interest Rates look like they're going to be heading higher for the next while. What does this mean for the price of housing and the availability of mortgage credit?
Oh, that's a huge question. Was doing some number crunching recently, just looking at, what could you buy in 2015? I kind of ran some numbers on that, and I looked at it, and I said, well, if you were to buy in 2016, you could buy with, and this is way more than the average household income, because back in 2015, the average household income was around $72,000 in Vancouver. Today, it's in 2017 going 2018, it's about $110,000 to $111,000. But in 2015, if you were looking to buy and had the household income to buy a $900,000 property, you need $140,000. That same $140,000 today, with the stress test and with the higher interest rates, is going to buy you somewhere in the order of about a $650,000 piece of property, or $620,000, depending on some ratios. That's because we're having to stress test that funds at the Bank of Canada benchmark rate, which is at 5.39 or at 2% above the face rate. So if you're getting a 3.49 rate, default insured, CMHC or Genworth, that's the better rate, because 3.39 would be, 3.89, 3.39, and 3.99 would be 5-year rates that are out there for uninsured mortgages. That's another question we can unpack. But just go from $140,000 to buy a $900,000 property, 10% down. Now you've got $140,000 today, 2018, and you're able to buy a $620,000 or $630,000 piece of property. That's a big drop. That's $280,000 difference in 3 years. And that's what the rules have done to compress that. So as rising interest rates go up, you're able to afford even less.
We'll have more with Glen Kelleway when we return on This Week in Money.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Glen Kelleway. Glen, in an interest rate environment that's trending higher, does a variable rate mortgage or a fixed rate mortgage make the most sense?
It depends on your long-term plans. It's a great question, Jim. Fixed or variable? It's always the question. I mean, there's some long-term stats that say the variable rate is the beneficial rate over a longer period of time. You know what? No one's taking a variable rate for 10 or 15 years. Philosophically, they may decide that variable is the way to go. Here's how I look at it. 2 out of 3, or about 60% of Canadians who take a 5-year mortgage will change that mortgage somewhere within the 60 months of that. So that means they're either going to, 50% of the Canadians who are divorced or in long-term relationships are going to get divorced. Long-term relationships are going to get divorced or separate. They're going to sell the asset. We're going to have a need for a HELOC or sell a piece of property, or something's going to happen to change that up. So that means if you're with a major financial institution, one of the big banks, you may, if you can't port the mortgage, hit an interest rate differential. That's where it could cost you 3, 4, or maybe even 4.5% of the outstanding balance as a penalty to break the mortgage with that big bank and then take a new mortgage with someone else. A variable rate means that you're stuck at 3 months interest. That's about 1% of the outstanding balance if you couldn't port the mortgage or if you couldn't qualify. You had to get other financing. So back to this question, do you take a variable or a fixed rate mortgage? Well, you have to ask yourself, I've got 2 bets that are happening. One, Am I going to be in that 40% that are not going to change things up, and I'm going to stay for my full 5-year term? I'm not going to need a line of credit or anything else that's going to require a change in the mortgage product. 2, I'm going to expect that the Bank of Canada is not going to increase 2 or 3 hops. So when we start out lower, like today, we have 289 for a deeply discounted default insured variable rate mortgage compared to 359. So we've got somewhere in the order of about 3/4 of a point of difference between those two. We expect next year, going forward, we'll see 2 or 3 rate hops. That's 1/4 of a point up and 1/4 of a point up. So if you're paying a lower interest rate right now, somewhere next year you'll catch up. And the question we've got is to say, if we are going to have 2 or 3 rate hops, are we going to look back 2 or 3 years from now and say, oh darn, we should have taken the 3.59 fixed rate instead of taking the 2.85 variable rate, which is prime less 1.1. In that case, if you break your mortgage, you're part of that 60% who do something and change up the mortgage, and probably the 30% who actually have to break their mortgage and hit a penalty. You're better off to take the variable rate because you've saved your costs going out. There'll be far more than typically the costs associated with paying a little extra interest. If you are on the other side and you're very risk averse, then maybe taking the fixed rate. But here's the thing. As a mortgage broker, I'm not going to put you into the big banks if you want a fixed rate. I'm going to put you over with one of my mortgage specialist banks, Amerix and MCAP, one of the other ones where if you do hit an interest rate differential, it's going to be 2 or 2.5% of the outstanding balance. It's not going to be 4. So that is where you need a mortgage broker to help guide you and say, which is, I like the fixed rate, but I might break it. I don't know. What is the lower exit cost for me? So back to your question, does a variable rate make sense in a rising interest rate market? Yes, on one side, if you may break the mortgage or change it, it's going to be your cheaper exit cost. But if you want the comfort, then you need to choose the appropriate lender that'll have the lower exit costs.
Most people, when they renew their mortgage, use their local bank, the one that they always bank with. Is that the best bargain for them? Do they feel they're forced to do it, or is it a matter of, I'm familiar with these people, they'll probably give me the best deal?
It's comfort. It's comfort with that. I mean, it's like going to your favorite restaurant. That doesn't mean that they're always good. Doesn't mean that you're not going to come away from that and not have an upset tummy for a period of time. The challenge with that is that you're dealing with the staff that are there. Like your restaurant, your favorite chef in the back is no longer the chef. They've gone on to work somewhere else. So you're not getting the same quality, or it's changed hands. And that's the challenge with the local financial institutions, is the staff turnover. If you come to someone like myself or a qualified mortgage broker who's got years of experience, they're going to go to the market and they're going to find the best deal for you. We're also going to look for other things that maybe you should think about long term. Many of us in the mortgage brokerage community are looking as to how we can help you pay that mortgage debt down faster. And that you may not get from the local bank, especially for a new person who's just come out of university and is basically filling out the mortgage documentation for you. So they do know you. They can provide you with similar financing. It's where you're going to get the best possible advice for paying that mortgage off faster.
If you're in a real estate market downturn, are HELOCs a big concern?
Thinking back to 2006, 2007, 2008, when prime was sitting at 6% and then they started cascading prime down, we had many clients with large HELOCs, but they hadn't drawn them down. So what we saw was lenders go and say, hey, the property value has fallen, 20, 30%. We're not going to let you have that big line of credit that has not been utilized, because it's a liability on the books. So they put a pair of scissors through the amount. So someone had a $750,000 unused secured line of credit. They cut it to $500 or cut it to $300. That was for a lot of uber wealthy clients that are just sitting there waiting to use those. They bought the property all cash and they put a line of credit on it just in case they needed to get access to the equity. What you will find, though, is if you're using the line of credit, my opinion is they will not do something with it. Worst case scenario, they're going to say you need to lock in a portion of that line of credit. And that may happen because then that changes it on their books, the bank's books. It's all about the back end and how they have to finance and how they have to have money ready to supply that line of credit. lines of credit are a liability for banks if they're giving you money from a fixed rate product, such as the fixed rate mortgage, 1, 2, 5, 7, 10 year. They're going to reach over to some investor, get the money off of a bond rate essentially, and hand you the money. So that changes how the bank manages that money. HELOCs are good, but I'm not in a downturn market. You're better off to get a HELOC in place now before the market turns down, so you have more access to equity in your property. I'm working with a number of my clients right now. We're refinancing so that we can get maximum access to equity in their property. They've got typically a fixed rate and a line of credit component behind it.
Do you find when there's a stock market downturn, people turn to their HELOCs to perhaps cover their margins?
You know what? I don't have a whole lot of clients that are using the stock portfolio for that. I could see them doing that to sort of cover the margins. I have clients that are borrowing to invest in other products. They're borrowing for real estate. They're borrowing for other investments, typically mutual funds. Not many clients actually borrowing to invest in the stock market.
We'll have more with Glen Kelleway when This Week in Money returns.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Glen Kelleway. Glen, are mortgage brokers able to offer people options when the banks turn conservative in their lending?
Yes, absolutely. Well, let's just say we can supply, there's a couple of companies out there that say you're approved. Yes, there is ways to get people approved. It might be only for $1 or $2 or $10,000. It might not be what they need, but there is a way to get people money. You need four things for lending. You need property. You need some way to pay it back, income. You need equity in that property, and then the credit history will derive some aspect of that. Where one of those four things is not as, say, equity is not as great, you need really good income, really good credit history, and a nice property. CMHC, 5% down, it's all about you. If you have impaired credit, you'll need more equity, the property will still need to be marketable, and maybe the income is not quite there, but the equity is going to protect the lender. Back to the idea of banks getting conservative, I have 3 buckets of lending. I have my AAA to my A- bucket, that's all big banks and trust companies, and it's pretty much all of from the discount to the best rates to just paying 0.5% or 1% more, say with some of the trust companies for business for self-lending. And then I have my bucket number 2, which are my mortgage investment corporations. I can go to any one of 70 to 100 mortgage investment corporations across across Canada. There's more. And they will loan money where the banks won't loan money. And then, Jim, you and I could loan money privately. So I have private lenders who will loan money where the previous two, the banks and the mortgage investment corporations, which take RSP money and TFSAs, they can't go because their shareholders' agreements that we would sign when we put money into a MIC would not allow them to loan. That could be loan to values, geographic regions. But private lenders like you and me, Jim, could loan money anywhere we choose. We could loan it way past what would be reasonable for any other lender. 3 buckets of lending allow me to go and find the money for the clients. I may say this doesn't make sense to clients and tell them not to do the deal. But that's my opinion coming with 16 plus years of lending experience and hundreds of thousands, millions of dollars loaned out.
Mortgages in Canada are mostly recourse loans. What are recourse loans, and what effect do they have in a real estate market downturn?
Recourse loans. So recourse loans, just for the listener out there, the idea is if I put the property up as the collateral, and you want the money back, but I can't pay the money, so the lender wants the money back, I just say take the property. If the property value has fallen and the lender tries to recapture all the money they've loaned and they end up in a shortfall, they're stuck with just the property. And that recourse loans, non-recourse meaning we don't just get to keep the property, exists in some places in North America and is in some loans, but you'll find most of the loans written in Canada will be recourse loans. That means that there is recourse on you, the borrower, your personal covenant, I promise to pay, if the debt cannot be recovered through the sale of the property. So step back from this, someone stops paying, whatever the reason is, illness, injury, and the lender then goes and recovers the property through the courts, but ends up in a shortfall. They will then come after the borrower who had their personal covenant or their promise to pay. CMHC will do this, so will banks, so will private lenders. They'll all do this where they can so that they can recover the investor capital.
In a real estate market downturn, is it extremely important for sellers to price their property to sell?
Yeah, in a real estate downturn, the challenge is we all want to get the best price for our property. But we're not looking ahead. We're not looking at where the property prices are going. We're looking behind us, kind of like driving through the rearview mirror. So we look at what our neighbors sold their property for, and we always think our price is as good or better than our neighbors. And they sold their property last month or 2 or 3 months ago for $1 million or $700, whatever it is. They've sold it $700, $1 million. We want to get the same price for ours. So if we price it as little as 5% above the fair market value, the today value, and this isn't a normal market. We're moving towards a buyer's market right now, or a balance to a buyer's market. As more product comes on, if you price it just a smidge above, you're not going to get offers. If you, as a seller, have not had offers on showings, but if you hadn't had anyone willing to write an offer, that should tell you something about either the state of your property. I'm assuming it's all pretty and marketable, but it should tell you something about the price. And if you're in the upper end of the market, there's fewer buyers. If you're right in that sweet spot of the market, probably somewhere between $750,000 for a condo or a townhome, or a house out in Mission or Chilliwack, up to about 1.5 to 2 million. If you're in the sweet spot of the market and you're not getting offers, you're probably priced too high. If you're priced a little bit below that, you'll get offers in this market, and then you can negotiate. So the challenge is as the property gets stale, it starts to lose value because everyone else is selling. And especially in a downturn market, you're better off to price a little bit below the market, 5 to 10% below the market, and then get offers in if you really want to sell. Otherwise, you're just out there testing the market.
If people have bad credit ratings, are mortgage brokers more likely to be able to swing them some kind of a financial deal?
Yes. If they have a bad credit rating, one of the things mortgage brokers can do is give you some advice. The experienced ones can give you some advice as to what you need to do to improve that. We actually have a tool that's coming up called Clever Credit. We're going to be able to offer clients. It's free for the first few months, but that'll give them some coaching on that. So I encourage clients to basically work with and understand how their credit score works. It's very important. Some of my loan products, you can get a better price if you've got a higher credit score. In general, credit scores in Canada go from, say, the low 300s, which puts you in the bottom 5% of the bucket, up to 900. In the top 8 to 900, that's probably the top 20 or 30% of the bucket. So can we get financing for people? Absolutely. Back to my 4 parts: property, income, equity, and credit history. If credit history is poor, then equity's got to be better, income's got to be strong to support it, and got to have a nice property. So you might have to instead put in, post-bankruptcy. Can someone get a mortgage financing post-bankruptcy? Absolutely. They've got to cleanly reestablish at least 2 to 3 years worth of credit history, and then they're probably going to need to have at minimum 10% down if the default insurance company will take on the risk. If not, they're going to have 20 or 25% down. So can I find it? And that would be with a major bank. If the major bank won't do it, then I have other lenders who will do this. Even one day out of bankruptcy, I can get financing if you have enough equity.
Do foreign buyers use mortgage brokers when buying property in Canada?
Yes, they do. Because foreign buyers do not have any income here in Canada. That being said, I can take a look at income that's offshore, and if we can map that somehow, the United States would be easy because we can track a whole bunch of stuff down there. But if it's in Southeast Asia or somewhere else in the world, it may be more difficult to track that income. So the lenders need to know there's enough income to support the loan. Let's just say one of my jumbo loan companies, jumbo loans are loans in the $2, $3, $4, $5, $10 million for luxury homes. They will look and they'll go maybe give 50% loan to value to a foreign buyer on a piece of property if they can't qualify the income. It might even be 45% loan to value. So someone's buying a $10 million home, they'll have to come in with $5 million or more in terms of equity into the property. But they might give maybe a $6 million loan on a $10 million property, or maybe even a $6.5 million, $7 million loan, if they can see where the income is to support that. So that's the challenge right now, is for me to put the deal together and find them the best possible financing we can based on what information we've got.
Glenn, with the Canadian Revenue Agency now cracking down on sourcing for mortgages and so on and finding out where money's really flowing from, has that had a big impact on the mortgage brokerage business?
Well, the banks absolutely have to make sure that there's there's significant due diligence on proceeds of crime, and it's anti-terrorist legislation. So they're looking as to where the source of funds are. If it's coming from mainland China, you got to see it in a bank account there. There's got to be enough trust, enough understanding that that is really the true source of funds. It's got to land here in a bank and then be transferred to some others. So it's got to be processed. It is causing some restrictions. Our 90-day history, I've had clients actually been asked to produce a year's worth of history on documentation to show the money was there. It wasn't borrowed from somewhere else. So that whole scrutiny of funds coming in it's been amped up.
Glenn, how can people find out more about Kelleway Mortgage Architects?
Well, you can find me. My last name is Kelleway with a K, Kelleway. You can put that in there. There's only 3 of us in North America that have that designation, and one's a hyphenated name, related family member somewhere back east. But my assistant here, Serena, who married into the family, is got the same last name. You'll find it on the web, or you can just put the word in mortgage it, like IT, RIGHT, right? Mortgage it right, and I'll show up in Google.
Glenn, thanks a lot for being on This Week in Money.
It's been a pleasure. Thank you, Jim.
My guest has been Glen Kelleway, the broker-owner of Kelleway Mortgage Architects, located in Maple Ridge, British Columbia.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Robert Campbell, Glen Kelleway, and thank you for listening. If you have any questions for the show, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Cypress Development President Bill Willoughby. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, your company just put out a news release. What was in it?
Well, it was an update, and it talks about what we've accomplished in the last 8 to 10 months. And it's pretty significant. The real crux of the whole thing is that we've developed 2 patentable IPs that will move this project forward. And that's a pretty good accomplishment in 2 years from the time we did our proof of concept. So Kinetco's been pretty diligent at that, but we wanted to explain what was happening. We're in the midst of doing another financing, so it was a good time to put out an update. And so we basically looked through what we had accomplished, and we've accomplished first off, of course, we've accomplished a lot of work on tightening up our process, our hydrometallurgical process, and that process was key to the whole thing. I mean, it sounds like you're starting at the back end of the whole exercise. But the reality is, if you can't get the cathode materials out, which is the biggest problem that most of these recycling companies have, they're getting any amount of it out, then, the rest of it is just spending money, hoping that you're going to be able to develop a process. So we've done that. We're very, very confident that we've got a hydrometallurgical process that will get 100% of the cathode materials, and our plan has been to use scraps. Scraps are what's left over from the production of manganese, and scraps, of course, entail the metals on pieces of foil. And they put it on foil and they make it into batteries, and they run a bunch of batteries, and lo and behold, they don't meet specs, and so that whole run gets scrapped, and that can represent 5 to 10% of the total battery manufacturing. So that's a big, big market. And eventually, you could be doing 100, 200 tons of scraps a day, so that's, again, a big market. We're over $10 million in proceeds from 3-ton-a-day scraps in a year. So the scraps are really important, and that's where we want to focus our attention at the moment. Is we've developed a method now that's patentable for getting the scraps off of the foils, and it may sound like a simple thing, but it's not. I mean, you end up with pieces of foil that have to be removed from the powder itself. But we've developed a method to do that, and then put it into a solution whereby it goes through the hydrometallurgical process. So that's 2 big milestones for the company in 2 years, and we are working away at finding a way to take the batteries robotically, take them apart, strip out the foils, and of course now we got the process for handling those foils. So those are big accomplishments for the company, and we've been very transparent about what we've done. We can't find anybody else with the same transparency without giving away the trade secrets. But we have we take the results from Kinetco, which is an arm's length company and researcher, and we publish those results. And it's not something that the boys in the office cooked up in their basement. This is a real process, and it's had some serious millions of dollars spent on it. So, we're very happy with that. I mean, wow. I mean, probably the easiest part is, getting the robotics to take the batteries apart. If they can use robotics to put the batteries together, I'm pretty sure that we can, should be able to use robotics to take them apart. So that's the next big step. But, all this work that we've done, it's cost us extra because we get submissions from companies around the world, battery companies, recycling companies that have material that's they feel is ready to go into the process. And we have to test that out. You know, some of them, they take it down to a small amount of the cathode materials, and then they use high heat, and then you introduce a lot of carbon into it. So there's all kinds of bottlenecks that you can run across. We're hoping that somebody would come across something that would be dead simple, and that we could actually joint venture or collaborate on that. So it's been a very exciting time. We have put out a press release today that pretty much describes all of that. And so we've had a large variety of global suppliers that are handing us their material to test. And again, we've gotten 2 of the 3 major milestones. So I feel that the company has made a great progress, and you know, this is, even if they reduce the amounts of cobalt that are, and they are reducing it in the cathode material and nickel manganese, cobalt specifically, which seems to be the popular one that everybody's going to. And, you know, it's still got a huge amount of value in that cathode material. So our goal actually is to take a process, streamline it to the point where our cost of recycling is really cheap. And that would keep us out there and in front. I'm not saying we're going to be the only recycler, because you're talking about multi-billion-dollar business. I mean, there's multi-billion dollars worth of scrap per year that are coming free that we could work on immediately. And, you know, getting the process down to the tightest formation really increases the profitability of the company. So, Jim, that's the thinking behind the process, the thinking behind the business plan, the thinking behind the opportunity. And the opportunity is great. I've never been involved in a company that has had success after success after success when it comes to their process. We're waiting for the patents. That's always frustrating. We're going to be starting up with the pilot plant here pretty quickly. So everything's coming the way we envisioned it, and we have one of the top researchers in Canada working on this process. So, you know, there's nothing that I can say that is not already explained in this press release.
Larry, for people new to the company, what does American Manganese do?
American Manganese is a critical metal company, and we have projects in the U.S. We developed a process to actually compete with the Chinese factories for manganese metals and dioxides, using grades that are less than 5 to 10% of the usual grades that you use, and being able to get them out at the same cost. We've taken that process and we've expanded on it and made some adjustments, and we've been able to get the cathode materials out of the cathode metals, and you know, so that's where the whole process took off.
Larry, where are you traded, and how can people find out more about American Manganese?
We're traded on the Toronto Venture Exchange under the symbol AMY, and we're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt, Germany under the symbol 2AM. You can reach me at lray@amymn.com, or you can get to our website at AmericanManganeseInc.com, or phone me at 778-574-4444.
Larry, thanks for the update.
You're welcome, Jim.
We've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on November 16th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Bill Willoughby, CEO and Director of Cypress Development Corporation. Bill, welcome to the show.
Thank you, Jim. Pleasure to be talking with you again.
Bill, Cypress recently brought out its economic assessment. What kind of news did you have for the people following the company?
Well, it was a very positive PEA. We completed that in October and poured out very strong economics behind that. We have a $1.45 billion NPV at an 8% discount rate behind a project that has about a $480 million CapEx and operating costs that comes in around $4,000 a ton for lithium carbonate. So very good economics, generated about a 33% IRR off of that. Right now we're very encouraged. We completed a $2 million raise just a week or so ago, and we're pushing forward to work on a PFS, pre-feasibility study, which we expect to have done in the first quarter of 2019.
Where do you go from there?
Well, where we go from there will depend, of course, on the results of the PFS. We fully anticipate moving the project forward and doing baseline studies and permitting and doing work to carry it forward to a production decision.
Bill, for people new to the company, can you describe exactly what Cypress does?
Well, Cypress is a mineral exploration company. Been around for 15 or more years. Previously was focused on smaller projects in base metals and gold. But in around 2014, 2015, the company shifted focus into the lithium space, and began by staking some claims down in Clayton Valley, Nevada, which is where our Clayton Valley Lithium project is located. And we started drilling on that project last year, around February. And in the course of about 18 months, we've carried it from exploration through a resource estimate to the PEA, and now we're working on PFS. So it's moved very quickly, and it's a very interesting project.
Bill, where are you traded, and how can people get more information about Cypress Development?
Well, we're on the TSX Ventures Exchange under the symbol CYP, and we're also on the OTC under CYDBF in the U.S., and you can get more information from our website, which is cypressdevelopmentcorp.com.
Bill, thanks for the update.
My pleasure, Jim. It's great talking with you again.
We've been speaking with Bill Willoughby, CEO and Director of Cypress Development Corp. I'm Jim Goddard. Our conversation took place on November 16th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.